Some people think the lending markets are transitioning, they're growing. They certainly have rebounded from the Great Recession. I'm here with Bill Kauffman. He's Managing Director of Oak Grove Capital. So Bill, how did 2013 end up for you guys? I know you did a few very large senior housing transactions. Anything that kind of stood out?
Well, the thing that stood out really, Steve, for us, if you think at the end of the year, we ended up with a great pipeline. We've already closed a couple loans in January. We've got a running start for the year. On a volume basis, last year we were just shy of 400 million. Could have been a bigger number. A few deals fell out with all cash buyers. That was disappointing. But that's the nature of the beast today.
Is there anything that you and your team at Oak Grove are focusing on now in terms of, type of property, type of borrower?
Yeah, we're going at, well, first of all, today, unlike in the past where you found the owner-operator, you grew with them when they were small to bigger, you've got to find out who actually is making the financing decisions with these financial partners.
Yeah.
That's a bit of a challenge. We're working with big borrowers, we're working with small borrowers, really trying to find the up-and-coming borrower we can grow with over time.
Seems like there's, I just read about there's new guys coming in, there's small guys who are developing nice pipelines of either acquisitions or development, so I would think that there's quite a few of those smaller guys you can grow with.
There are. Most of them are veterans from bigger companies.
Right.
There's a lot of equity out there. They find those equity sponsors. In some cases we recommend equity sponsors for them. But yes, they're out there, clearly.
And you've done a lot of HUD in your career as well as Fannie Mae. What are borrowers, today, or what are they coming into your office for? Is it more of the Fannie Freddie? Is it the HUD?
What are they coming to our office for? I wish it was that easy. Yeah. I know I've been in the business for a while, and actually, if anything,
they just come and see you.
Yeah, I wish that it was that easy. And someone joked recently to me. He said, "Bill, there's just too many of you, as in Fannie, Freddie, HUD shops, and not enough product." Yeah, it's funny. I wish it was that easy. We have, and you really have a bifurcated business. If you're in the HUD business, you're doing lien. That's primarily skilled nursing. We've actually brought on a dedicated lien originator. He's based in Columbus, Ohio. He knows the product really well. He's got 3 deals signed up early, and that's a business we're going after in a bigger way. It's something we should do more of since we do it well. We're not going to be the medium and large portfolio type player in that space. The borrowers on the senior side, we are again looking for those smaller up-and-coming operators. Properties have changed hands. It's a game of musical chairs with one private equity group to another private equity group. We just need to be sure we're involved in all those contact points with advisors,
Right.
the different private equity sources, and staying in touch with all of them. Those borrowers, on the Fannie Freddie front, depends on their time horizon. They're looking for fixed and variable.
Yeah, that's you bring up twice you brought up the private equity partners, and that's got to be a little bit different in terms of is the decision maker the borrower, the operator, or is it the equity source? And the equity source is going to probably have a different rationale for borrowing a certain
Yes,
product.
and it's the operator private equity relationship is different in each structure.
Right.
The decision makers are different. The interest levels are different. There are some operating partners who actually sign on documents as opposed to the equity side. Others that don't. It's an interesting mix. It's almost as if you need a scorecard to keep track of all the different arrangements, which makes it a lot more difficult than it was, say, 15 years ago when you were focused on owner-operators.
Right. No, absolutely. For several years, all we heard about and we talk about, interest rates are going to go up, interest rates are going to go up.
Right.
And they finally, last May, with the Fed announcement, they bumped up 100 basis points. Subsequent to that, what happened with your clients? Did people start thinking, geez, I better lock in rates now? Or did people say, you know what, the floating rates are still at historic lows, let me still go floating?
Yeah. Again, if you look at the two sides of the business, HUD was definitely impacted. There were a lot of deals that fell out because of the
on the refi, yeah.
Yeah, the refi side of things. Made a huge difference on the HUD side. Deals in pencil, as well. With the on the agency side of the business, it really depends on the borrower's time horizon and their tolerance for risk. there are borrowers who are very comfortable taking, variable rate deals, and they figured out that if I can save money, I can save, say, 200 basis points over a 2-year horizon, I'm better off in the long run by going variable rate. There are other borrowers who go variable rate because they plan to add to properties and want the flexibility to pay it off to get a construction loan, or they don't want to get themselves locked into yield maintenance for 10 years, and they think they might want to sell in 5. And the variable rate pricing gets very attractive.
Yeah, oh,
and for that matter, LIBOR has gotten lower over time. Sub 20 basis points. And another feature, if you go back historically, there are a number of agency loans that are maturing today from a time period when you did a 10+1 or 7+1, and those were fixed rate loans where you got that little tag year, 1 year tagged on at variable rate. At that time, LIBOR was 4. And the spread was, say, 250 over LIBOR. Well, the borrower said that's a 6.5 rate. I'm never going to use that. Well, lo and behold, now they're looking at sub 3. I think I might take that year. So that's worked out well for them too.
Talk about history there. You've been through a lot of cycles in this industry. Is there anything out there that makes you nervous in this current environment?
I would say, anytime there are a lot of names I don't recognize, and in terms of corporations, whether they be operators or equity partners, and you do a little digging and the resumes are thin, they don't have the scars, they don't have the same, especially the equity guys who are gung-ho to get in the space, that troubles me. There's a lot of building going on. First of all, I think that's healthy. Secondly, I don't think it's an oversupply at this point in general. And third, it's going to create some opportunities down the road because some of these will be failures at some level, either the wrong site. There'll be opportunities for someone else. Oftentimes, the second, third owner coming in does well. But I do get a little worried. I don't think the great wave of the 80+ population is going to be coming for another 5 years or so. But so far to date, there are quite a few names that I don't recognize yet, but I'll get to know.
I hope so. You work with some of the largest companies, and you work with small providers. What's the difference when you take them to the market?
I'd say it's interesting. That's an interesting question. In many ways, it's the same. Our whole proposition with the borrower is we explain how to get you through an agency or HUD deal. And as sophisticated as big borrowers are, and if they've done it before, there's still nuances. They don't want to have to do this full time. They want a knowledgeable mortgage banker to walk them through the process. With a new borrower, first time transaction, smaller borrower, it's incredibly gratifying to get their first agency or HUD deal done. With the bigger borrowers, because of the number of properties, you got more bells and whistles. We do a lot of credit facilities. We've done several in the last 3 years. We're looking at both Fannie Mae and Freddie Mac facilities today. Both great products. We can offer those to bigger borrowers, but you wouldn't do that with small borrowers. That's one major difference.
All right. So tell me, why should borrowers come knocking on your door, even though you're knocking on their door?
Why should we stand out?
Why should they come to you for money?
Yeah, I made a conscious decision 3 years ago, and I had a chance to change companies. And I like the fact that Oak Grove is privately owned. It's not private, capital-led or private equity, not owned by a bank. Very focused on the customer. We give terrific service. We hire knowledgeable people. It's all about getting the deal done as painlessly as possible. Have a few laughs along the way. Don't make this overly complicated. And being able to be flexible and nimble enough so if we work on a 20 property transaction, we pull a team together and get it done. And it gets done well. Okay,
very good. Well, good luck in 2014, and I'm just going to make the assumption you're going to keep on growing.
I think that's a safe assumption.
All right, great.
Thank you.
Thanks.